It's official. Regulators are going after stablecoins. The US Treasury Department is reportedly considering sanctioning USDT issuer Tether in a move which could send the crypto industry back to the dark ages. There's just one problem, and that's that stablecoin issuers like Tether hold hundreds of billions of dollars in US government debt. If forced to liquidate, this could lead to turmoil in the markets. And that's why today we're going to summarize a report that reveals how US regulators are thinking about these too big to fail crypto companies, and whether they'll try and replace them with dystopian CBDCs. Watch until the end to find out what it could mean for the crypto market. The report we'll be summarizing today is technically a presentation that was given to US Treasury Department officials by the Treasury Borrowing Advisory Committee, or TBAC, back in October. The summary of the presentation is a hefty 132 pages, but we'll be focusing on the part that's about crypto, obviously. Before we dig in, though, a bit of a background is necessary. As most of you will know, stablecoins are digital crypto tokens that are pegged to fiat currencies, typically the US dollar. These stablecoin tokens exist on smart contract cryptos like Ethereum and are used for everything from trading to DeFi magic. What you may not know is that stablecoins are backed mostly by US government debt, aka US bonds. And this means that when you buy a stablecoin, US bonds are being bought behind the scenes. And this is for several reasons, mainly because bonds earn a yield for the holder and they're also very liquid. In plain English, stablecoin issuers back their stablecoins with US bonds because they can earn an interest rate on those reserves. And since these stablecoin reserves are in the tens or hundreds of billions, this means that stablecoin issuers can earn billions of dollars in what is basically passive income. As for the liquidity, this simply means that US bonds can be bought and sold in large amounts without moving the price. And this makes it possible for a stablecoin issuer like Circle to, say, sell $100 million worth of US bonds for $100 million to give to someone who's cashing out of its USDC stablecoin. If Circle was to try this with a less liquid asset, like, say, small cap stocks, it would not be able to sell $100 million worth of that stock for $100 million. And that's just because the sell pressure would cause the price of that stock to go down, leaving Circle with, say, $95 million instead of $100 million. I'll quickly note that Circle does not back USDC with stocks, and that it also keeps a very large cash pile handy to process withdrawals in a timely manner. You can see our recent interview with Jeremy Alia, the CEO of Circle, over on our More Coin Bureau channel. The link is right over here. Now, this is where things get interesting. Governments don't like stablecoins because they're essentially a form of money that they can't control, kind of like crypto. Of course, the difference is that stablecoins are centrally controlled by their issuers, which can seize or freeze your holdings, unlike an actual crypto. In any case, the exact reason why governments don't like stablecoins depends on the government in question. Governments in countries with their own national currencies don't like stablecoins because almost all are pegged to the US dollar, which effectively creates competition for non-USD currencies. In the case of the US government, it doesn't like stablecoins because they theoretically pose a systemic risk to the financial system. Imagine a scenario where a stablecoin is backed by $1 trillion of US bonds, and that something happened that caused its holders to redeem the tokens for US dollars. This means that the stablecoin issuer would have to sell hundreds of billions of dollars of US bonds in a very short period of time. The US bond market is liquid, but it's not that liquid. This selling would cause the price of US bonds to fall, and that could cause the financial system itself to implode. And that's because US bonds are the main form of collateral within the financial system. In other words, most investors use US bonds as collateral to borrow more money. If US bond prices were to fall, investors would borrow less or even default, causing a contraction in money supply and crashing, well, everything. If you think this sounds like a Ponzi scheme, you're not alone. A financial system that's based on debt all the way down to its very foundation is inherently unstable and requires ever more money printing to keep it from falling over. And this is why crypto was created and why it will eventually replace the existing financial system. And by the way, if you're enjoying this video so far, why don't you smash that like button to let us know, and subscribe to the channel and ping the notification bell as well so you don't miss our next video.
Hello, it's me, guys, Cousin Barry. I'm very sorry to be interrupting this no doubt fascinating video, but I want to tell you about the Coin Bureau deals page, so listen up and listen well. Alright, this is the place where you will find all the amazing promos and discounts what you, as Coin Bureau viewers, are entitled to. So don't be a mug, go and check it out using the link below. You'll find discounts on hardware wallets, you'll find exchange sign-up bonuses, some of which are absolutely bleeding mental, and you will find trading fee discounts there as well as a whole load of other goodies too. And let me tell you, old Barrington here, he's had to hammer the dog and bone all bleeding day and night to get you these promos and discounts. So you're welcome, thank you very much, go and have a look pronto, or I have to come and have a word. Alright.
Now, with that bit of background in mind, we can dig into the summary of the TBAC's presentation. The section about crypto is titled, quote, Digital Assets and the Treasury Market. For context, bonds are also referred to as treasuries. We'll leave a link to the report in the description, page 107, if you need it. The presenters, i.e. the authors, note that crypto adoption has been growing, but that so far it's been limited to investment purposes. What's fascinating is that the authors specify that cryptocurrencies' growth, quote, thus far does not seem to have cannibalized demand for treasuries. Perhaps we're reading a bit too much into it, but it sounds like the US government is concerned that cryptocurrency could compete with US bonds someday. For reference, financial institutions once held gold as their main reserves, not US bonds. As digital gold, Bitcoin could theoretically play that role too. Case in point, the authors themselves acknowledge that Bitcoin is perceived to be digital gold. This is significant because it wasn't that long ago that the US government dismissed BTC as a speculative asset. Now we have US government officials referring to BTC as digital gold, albeit a speculative digital gold. Well, we'll take what we can get, but consider that even this would have been unthinkable just a few years ago. Anyways, another fascinating thing is that the authors see the crypto industry as falling into two buckets, BTC and speculative altcoins, and altcoins with actual utility, including stablecoins. They point to the exponential growth of the total market cap of stablecoins and say it's for a number of reasons. The first is offshore dollar holdings. People will hold stablecoins as a de facto US dollar bank account. The second is, of course, DeFi, wherein stablecoins are often borrowed against cryptos like ETH to speculate on altcoins. And the third is the most significant, and that's trading, with 80% of all crypto trades involving a stablecoin. Next, the authors point out what I mentioned earlier. The growth of stablecoins has resulted in a, quote, modest increase in demand for US treasuries, which you'll recall are synonymous to US bonds. The authors estimate that stablecoin issuers hold $120 billion in US bonds, which is a lot. Lo and behold, the authors underscore the fact that if stablecoins continue growing, they could pose a risk to the financial system. And they also reveal that the medium and long-term growth of stablecoins will depend on stablecoin regulations, which will, quote, determine the fate of stablecoins. Yikes. Oddly enough, the authors don't seem to take issue with the even more exponential growth of tokenized US bonds, which they refer to as, quote, on-chain safe haven assets. And this suggests that they aren't opposed to stablecoins per se. They're just opposed to the fact that they're privately controlled. And this ties perfectly into the next slide, wherein the authors tacitly argue that central bank digital currencies, or CBDCs, are digital currencies, not stablecoins, which they see as analogous to money market funds. To be fair, stablecoins are similar to money market funds, but they're not the same. In fact, stablecoins are more similar to CBDCs than they are to money market funds. Both are centrally controlled, meaning that they can be frozen or seized by the issuer. Both can be surveilled by the issuer, and both are programmable, meaning that they can be designed to do things like limit your meat purchases. But alas, that level of control, it's not enough. If you've watched our video about the financial system the Bank for International Settlements envisions, you'll know that it involves tokenizing everything you own on a private and permissioned blockchain controlled by the government. You'll own nothing and be happy. The authors seem to be a fan of this idea because they showcase how everything from housing to art could be tokenized. It's safe to assume this would not be done on a public and permissionless blockchain, and that's just because the authors put crypto into a completely different category, and that's digital assets. The authors go on to detail the technical aspects of tokenization, including how regulation and compliance can be embedded into every single token. They speak at length about how incredible this would be, specifying that it would be, quote, independent of cryptocurrencies like Bitcoin. Not surprisingly, they call for a single unified blockchain that would host all these tokenized assets, operated in part by central banks. What is surprising is that they say the quiet part out loud. Quote, CBDCs will likely need to replace stablecoins as the primary form of digital currency. And this begs the question of how exactly this would be done. We suspect the answer would involve a financial crisis that's triggered by a run on a stablecoin issuer. And this would give the US government enough justification to not only crack down on stablecoins, but also roll out CBDCs, and not just in the US. Regardless, the authors then showcase a few projects that are tokenizing US bonds. The first group involves asset managers like BlackRock, which have been tokenizing US bonds on smart contract cryptos like Ethereum. And the second group involves megabanks like JP Morgan doing the same on their own private permissioned ledgers. The third group is one that you may not have heard about. In short, the Depository Trust and Clearing Corporation, or DTCC, is coordinating tokenized treasury pilots with various financial institutions. And for those unaware, the DTCC is kind of like the back end of the traditional financial system in the US. After looking at the benefits of tokenizing US bonds, the authors then do a deep dive into the associated risks, and a few stand out. The first is the privacy risk, which only applies to tokenized treasuries on public and permissionless blockchains. FYI, crypto blockchains, they're transparent, meaning you can see all of the transactions that have taken place on them. And this is why we're bullish on crypto privacy as a niche. When crypto adoption goes mainstream, it will quickly become clear that privacy solutions are required, particularly for wealthy individuals and large institutions. For example, central banks won't want everyone to see what cryptos they're holding or how much. Anyhow, the second risk of tokenizing US bonds is leverage risk, which would involve using tokenized US bonds as collateral to borrow crypto to do things on-chain. Now, imagine a scenario where the US bond backing this tokenized US bond was also being used as collateral off-chain. I wouldn't put it past them. And this relates to the third risk of tokenized treasuries, which is the most important of all. And that's stablecoin runs. Quote, runs on stablecoins have been a common occurrence in recent years, and the collapse of a major stablecoin like Tether could lead to a fire sale of short-dated treasuries. Translation? The scenario that we outlined earlier could in fact lead to instability across the financial system. And this is likely the main reason why US regulators like the Treasury Department are reportedly targeting Tether. If USDT keeps getting bigger, then Tether could actually become too big to fail. And this basically means the US government would be forced to bail out Tether if there was a run on USDT, the same way it had to bail out the banks in the 2008 financial crisis. And this pertains to the hypothetical scenario we mentioned earlier, where a global financial crisis could be triggered by a stablecoin run. In the interim, though, the US government seems to be more focused on the boogeymen of illicit activity, which the authors insist has been growing alongside the growth of the crypto market. And this may be true in absolute terms, but the percentage of crypto transactions related to illicit activity has, of course, been falling. Whatever the case, this crypto myth makes for the perfect segue to the author's next topic, and that's explaining why public and permissionless blockchains should not be used for tokenized treasuries. They say a lot that's fully false, like crypto not being fast enough and that decentralization creates vulnerabilities. In truth, the opposite is the case. Crypto is fast enough and decentralization creates resiliency. The only reason the authors mention these things is so that they can justify the real reason they hate crypto blockchains. They can't be controlled. Newsflash, the government wants to control everything. And because crypto can't be controlled, many governments have opted to try regulating it out of existence or into compliance. The authors lament the fact that these regulations are fragmented, without realizing that other countries have an incentive to embrace crypto due to its various benefits. Funnily enough, the authors themselves acknowledge the benefits that stablecoins have brought to the US government near the end of this section of the report, or rather the presentation. They note that stablecoin issuers will create structural demand for US government debt by constantly buying US bonds. But in the same breath, they warn that the increase in US bonds held by stablecoin issuers would increase the potential side effects of a stablecoin run. They ponder the possibility of introducing regulations that would make it harder for stablecoin holders to cash out as quickly to mitigate these effects. Believe it or not, but the authors advocate for the continued growth of tokenized treasuries on crypto blockchains, purely because they're convinced that everyone would buy them when crypto crashes. They also say another quiet part out loud. If US bonds are tokenized on crypto chains, more people will buy them. The authors conclude by reiterating that crypto is small but is growing fast, that the growth of tokenized assets should occur on, quote, unified blockchains controlled by governments and central banks, that CBDCs could and should replace stablecoins, and that the risk of these innovations should be mitigated. Fortunately, they say that the size of the stablecoins and tokenized treasuries is small for now. Unfortunately, this presumably means that the US government knows it can crack down on stablecoin issuers with minimal disruptions to the financial system, and that the time to do so is running out. And this brings me to the big question, and that's what this means for the crypto market. The answer depends on what the Treasury Department decides to do about stablecoins. It turns out that the headlines weren't lying for once. The Treasury Department wants stablecoins out and CBDCs in. The thing is that the Treasury Department isn't the only party involved, and this is where things get interesting yet again. If you watched our summary of the Binance settlement, you'll know we kind of speculated that big players like BlackRock, for example, negotiated a deal behind the scenes to minimize crypto market disruption. And this is because BlackRock's mission is to, well, make money, and it knows that there's lots of money to be made in crypto. If Binance had been completely shut down the way that the US government wanted, this would have meant less profit for BlackRock and other asset managers who are involved in crypto. If you need more concrete evidence, look no further than the numerous reports of asset managers like Fidelity lobbying anti-crypto regulators like the SEC to do pro-crypto things like approve spot ETFs. Heck, even SEC Chairman Gary Gensler himself admitted in testimony that the SEC listens to these big players. It stands to reason that Larry Fink has the Treasury Department on speed dial too, especially when you consider how involved asset managers are in US bond markets and elsewhere. And this is where things get even more interesting, because USDC Issuer Circle is backed by BlackRock, and BlackRock manages USDC's reserves. And again, BlackRock understands very well that a takedown of Tether would nuke the crypto market the same way that a takedown of Binance could have done. As such, it's not far-fetched to assume that there are similar negotiations behind the scenes to ensure there's a smooth transition if a crackdown did happen. Specifically, BlackRock could be trying to find a way to transition the entire crypto industry away from USDT and to USDC. In case it wasn't clear enough, USDT is used primarily for crypto trading. And per the Treasury Department's own report, 80% of crypto trades happen against stablecoins, mostly USDT. The problem there is that USDT is even more integrated into the infrastructure of the crypto market than Binance was. Whereas Binance is just a hub for trading and liquidity, USDT is the liquidity. It is literally the lifeblood of the crypto market, and it reaches into every corner of crypto, on-chain and off-chain. Attempting to forcefully transition the crypto industry away from USDT would therefore be very disruptive. You wouldn't be able to do it without breaking something somewhere in the market. And if something does break, then it could put pressure on the US bond markets, per the Treasury Department's own admission. And this means the Treasury Department and asset managers like BlackRock are stuck between a rock and a hard place. If they crack down on a large stablecoin issuer like Tether, it will pressure the bond markets, which will create issues for Janet Yellen, and it will crash the crypto markets, creating issues for Larry. Meanwhile, Tether has been quietly diversifying its business behind the scenes, expanding into areas like Bitcoin mining and AI, almost as if it knows the big players are trying to figure out how to get rid of USDT. As things stand today, though, this is not possible to do, and that's very good news for crypto. Not only that, but if the US government or asset managers were to try and manufacture some crisis of confidence in USDT, it would have the same negative effects on them. And this means that Tether could very well be too big to fail. But let's just say some powerful entities don't care how their actions affect others. And some powerful entities want CBDCs rolled out. A financial crisis triggered by the collapse of a massive stablecoin sometime in the future would be one way to justify such a course of action. Let's remember that one. And that's all for today's video. If you learned something new, be sure to smash that like button to let us know. And if you want to keep learning, consider subscribing to the channel and pinging the notification bell as well. And if you want to help others learn about stablecoins, then be sure to share this video with them. As always, thank you very much for watching, and I'll see you in the next one. This is Nick, out.